and put in sort of safety or protection for Greece, for Spain, Italy, and Ireland. But that remains to be seen.
Raghu, you know, when I started my investment career, there was no euro and the markets worked fine. Given that the euro is less than 20 years old and it is causing so many challenges, should the euro be saved?
You know, there are benefits to the euro that have sort of been there for some time. Clearly, one benefit which we now regret is that countries saw their risk premium fall considerably, and the inflation risk premium also fall, and they could borrow at extremely low rates, which were probably unjustified in hindsight. But having a common currency does help in a variety of ways, including reducing the transaction costs of cross-border transactions. What hasn't worked really is all the discipline that comes with having a common currency zone. So, you know, that sets people talking about the possibility of breaking up because we don't have the kind of political solidarity and we don't have the kind of common economic discipline to justify a common currency zone. The problem, of course, is it's a little bit like a Chakravyuh. Once you get in, it's very hard to get out without paying enormous costs. And that's where the euro area really is. That the costs of breakup now are tremendous, and you know, if in fact the euro area breaks up, I think you could see deep recession in much of the euro area for some time. So you know, this is one of those situations where if you had to start again, you wouldn't do what you did, but you are where you are. And I think muddling through is really the best option on the table right now.
What is your outlook for the euro? I mean, it's weakened quite a lot.
Well, one of the questions that everybody has is, why is the euro still so strong, given all these concerns? And it may be that the euro really is a combination of two kinds of currencies right now. One is the very strong northern euro, which is based on the economic strength of Germany, Austria, Netherlands, and so on. And the other is a very weak southern euro, which is based on the fragilities of Spain, Italy, Portugal, and you know, the combination of the two is a moderate euro at 124 or so, 120, 124 to the dollar. My guess is that people don't know how this thing will pan out. And if it does break up, we will see a very strong component of the northern euro. And if that is what inherits the euro, so to speak, that is the periphery countries get ejected, then it will be a stronger euro than it is now. And perhaps that is what is holding the euro up more than the fundamentals would indicate.
So if you were advising Angela Merkel, what would you advise Germany to do?
If I were Angela Merkel or advising her, I would stay the course and do more, but especially focusing on keeping the banking sector in these countries alive and going. But I would also keep the pressure for reforms strong. And you know, I think eventually the idea that we will reform Europe's institutions to resolve this crisis is probably, you know, wishful thinking. To change the institutions, the political institutions, the economic institutions, the fiscal institutions, to try and resolve this crisis, that's a step beyond what the people of Europe want. They don't want integration of the kind that sometimes Angela Merkel talks about. But I think that you know, creating specific targeted institutions to resolve this particular crisis, like the European Stability Mechanism or the EFSF, those might be the way to go. And I think down the line, probably Spain and Italy will enter some kind of program where they agree to do things in return for money, and that eventually will be the way that hopefully Europe will resolve itself.
So a lot of political action required to steer the Eurozone out of this crisis. We are headed for a short break now, but when we return, we talk to Raghuram Rajan on the impact of this crisis on India and other emerging economies. So stay tuned. Welcome back. You're watching Global Insights with me, Punita Kumar Sinha. And Raghuram Rajan joins us from Chicago to talk about the Eurozone crisis. Raghu, how does the Eurozone crisis impact India, and what are the risks for India and the emerging economies if the Euro area breaks up?
It is something that India cannot take lightly. Of course, India's exposure to Europe has gone down over time, and its exposure is more towards other emerging markets, to the Middle East, to Asia. But those countries are also directly or indirectly exposed to Europe. So I think the direct and indirect trade exposures can be substantial, and we should not dismiss them. The second source of exposure has to be from the financial, that there are so many ways that Indian companies have borrowed from outside, but also Indian banks operate in various markets where European banks operate. European banks are in India. So those are ways that the transmission from the financial sector can emerge. And as we saw in 2008, there are risks even in a relatively insulated economy like India's, for example, from trade financing, which can dry up very quickly. And the third element is confidence, investor confidence, for example. A flight to safety typically goes into the rich economy assets, into Japan, into the US, into Australia, and away from the emerging markets. And that tends to put a lot of pressure on equity prices, as also, the shortage of risk capital in those markets. So those are the ways I think these things flow into the emerging markets, and I don't think emerging markets should take these risks lightly.
Do you think that emerging economies like India would have to keep devaluing their currencies to increase competitiveness?
I don't think devaluation is a conscious decision in many of these countries. That when the markets take fright and start pulling back, what tends to happen is that the currency starts depreciating. And so long as the central bank doesn't intervene in a big way, that tends to increase the competitiveness of these countries, at least in the short run. And that serves as a buffer to the to the fact that money is flowing out. I think that there is the potential for currency weakness in emerging markets, especially as risk appetites wane amongst international investors. I don't see it, unless it becomes excessive and sharp, I don't see it as an unmitigated cost. It has blessings in the sense that it does help improve competitiveness. Of course, one should temper that statement by saying when the world, as a whole, is having problems, becoming more competitive is not particularly useful, because who you're going to export to? Everybody's shrinking their exports. And typically quantities tend to fall at that time of trade. So with that caveat, I don't think that so long as it's controlled depreciation or moderate depreciation, I don't think it's too much of a worry.
What structural problems do you see for India that could pose risks to its growth story, and what advice would you give the Indian Prime Minister?
Well, this is what I'm going to determine over the next few weeks. I have some ideas, but I don't want to prejudge them without figuring out what the ground realities are. So let me punt on that question. This is something that I will have more to say down the line.
So where would you invest right now, given the global economy and risks?
I wish I knew. I would be a rich man. So I think what you want to do is diversify. Diversify across areas, across asset classes, across maturities, across risks. And if you are diversified in that way, I think you stand a better chance, given the tremendous levels of uncertainty, than if you have all your eggs in one basket. So this may seem relatively commonsensical advice, but I think it's the best that I can give.
Raghu, thanks so much for that. Let's now look at some of the data points from financial analysts and economists for their forecasts. Tanveer Gill joins to discuss these data. Tanveer, what does the data show?
Well, it's not very encouraging, Punita. But let's start off with what's happening on the currency, which is the euro. The 4-year chart of the euro reflects that the euro is pretty much close to its June 2010 lows at 1.1.